director's loan account is an item that is represented on a company's balance sheet. It will either be there as an asset of the company or as a liability. The two differences being is that where it represents an asset of the company, it means that the director owes money back to the company from funds that they've withdrawn. Where it is showing as a liability of the company, it indicates that the director has invested funds or introduced funds personally into that company to assist with cash flow or capital purchases, and that has not yet been repaid to them. A director's loan account may be used as a form of business financing, where the directors would prefer to introduce funds into the company personally rather than going out to the market to seek funding from banks or other types of lenders. The main differences with this is that where a bank introduces funds to a company, they will often seek security over the company's business and assets. Where a director is introducing funds personally into a company, whilst they could seek to obtain such security, often they don't because they're introducing it because of their vested interest within the business, with a view to being paid back at some point in the future. A director's loan account will often be recorded in a company's financial statements or balance sheet as either an asset or a liability. Where it's an asset, this is where a director owes money back to the company because either they've drawn funds out to utilise for themselves personally, or it may be that they've taken dividends at a time when the company was not in a position to pay such dividends. Where this happens, the company's accountant will provide a transaction within the company's accounting process that accrues this director's loan account. Where it is presented as a liability on the company's balance sheet, this indicates that the director has introduced funds personally into the company and they've not yet been repaid back. The considerations a director should have when they are withdrawing funds as a director's loan account is that ultimately this amount must be repaid to the company. This is whether the company is continuing in a solvent trading position or whether it is going into an insolvent position and will ultimately end up in an insolvency process. Where the company is continuing to trade and is solvent and there is the presence of an overdrawn director's loan account, there must be consideration for the risk that this accrues what's known as Section 455 tax, which is an element of corporation tax. If the director's loan account is paid back in full within a 9-month period of the end of that accounting period, then the Section 455 tax may be repaid to the company. A director's loan account can affect a company's financial health and cash flow in two ways, and that is dependent upon the type of director's loan account we have, whether it is overdrawn, meaning that the director owes money back to the company, or whether it is resulting from the director introducing funds into the company. Where it's an overdrawn director's loan account, the impact on the company's cash flow can be significant and can be severe. A director must be conscious where withdrawing funds from a company as to the implications of those funds being taken out. Is that withdrawal causing the company to go into an insolvent position? Where a director is introducing funds into a company, the key and obvious benefits are that will increase the company's cash flow. It will increase the company's ability to potentially make capital purchases and will assist the overall financial position and health. The risks of mismanaging a director's loan account are twofold, and this again comes back to how that director's loan account is represented in the company's financial statements. If it is an overdrawn director's loan account, the risk there is that amount must be repaid, and that is whether the company is solvent or goes through an insolvency process. The risk where a director's loan account has accrued as a result of the director introducing money into the company is that amount may not be repaid to them if the company ends up in an insolvent position. The additional risk here is that a director may wish to withdraw funds from the company where they are owed money as a result of a director's loan account. Where this is the case, a director must be conscious of the fact that if there are other creditors, all creditors must be treated equally and fairly. Where a company is solvent, repaying a director's loan account is simple and straightforward. It's merely a case of introducing the appropriate funds into the company and making sure that the introduction of those funds has been recognised within the company's accounts for the appropriate accounting period by your accountant. Where a company is insolvent and a director owes money to a company as a result of an overdrawn director's loan account, that amount is still classed as a realisable asset. An insolvency practitioner is charged with acting in the best interests of creditors with a view to realising the company's assets to provide a return to those creditors. As a result, the insolvency practitioner will have to request full repayment of that director's loan account. Ordinarily, what happens from that point forward is a conversation or correspondence between the insolvency practitioner and the director regarding their ability to repay and their means and financial position. The benefits of maintaining a well-managed director's loan account is essentially managing risk on your position as a director. Where you've introduced funds into the company, it's managing the risk that you may not be repaid those funds in full. So keeping an eye on the amount of funds that you've introduced into the company. Where you've taken funds out of the company, it's managing that risk of what you're going to have to pay back if the worst happens and the company ends up in an insolvent situation. The best way of managing that risk is keeping direct dialogue with your accountant to ensure you're aware as to what accounting policies are being utilised. More importantly, keeping an eye on how you draw funds from the company, whether that's payroll and dividends, and if so dividends, whether the company has sufficient profits to pay those dividends, because the company could well be accruing an overdrawn director's loan account without you knowing about it. The additional risk with a director's loan account, where you've introduced money into the company and you're owed money, is where you're repaying yourself that director's loan account. If you're repaying your director's loan account and that is in preference to other creditors, then there's a significant risk that where the company may enter an insolvency process in the future, you will be requested to repay those funds. When you're contemplating repaying a director's loan account to yourself, it's very important that you ensure that all creditors are treated equally and fairly. This will avoid criticism wherever possible and ensures a well-maintained and managed director's loan account position.